I'm so glad to see that you survived our first test, chapters 1, 2, and 3, and you're back for a next one. Today's video is on chapter 4, and chapter 4, the primary topic, chapter 4, is closing journal entries. There are actually two purposes for closing journal entries. It's always better, I think, that when you're going to go through a procedure in accounting, before you go through it, to know why are we doing this? Why do we do closing journal entries, or for that matter, any other process in accounting? It's always easier if you know why you're doing it. So there are two purposes for closing journal entries. And the first one you see there is to close the revenues, expenses, and withdrawals so that they have a zero balance to measure income and withdrawals for the next period. In other words, these accounts, particularly revenues and expenses, are used to summarize the income for a period of time. And so at the end of that period, when we're done with them, we set them back to zero so they'll be ready to start measuring income for the next accounting period. The second purpose of closing journal entries is to transfer the effect of revenues and expenses and withdrawals to capital. All three of those accounts eventually affect capital, and so by doing our closing journal entries, we're taking the effect of those accounts and transferring it into capital. So those are our two purposes with closing journal entries. There are 4 steps in the closing process. Let's go through those one at a time. Before we do that, though, there's a few little tidbits I wanted to give you, or some helpful information about closing journal entries. First off, you only do closing journal entries on the last day of the accounting period. If you find yourself starting to do a closing entry and it is maybe September 11th, stop yourself. You only do closing journal entries on the last day of the accounting period. That could be September 30th, could be December 31st, depends on whether your organization has a monthly accounting period, quarterly accounting period, or full annual accounting period. Second tidbit I wanted to tell you is to only close temporary accounts. Temporary accounts are revenues, expenses, and withdrawals. Those are your only 3 temporary accounts. If you find yourself closing some other type of an account, stop yourself and remember, only revenues, expenses, and withdrawals. Next thing, assets, liability, and equity are never closed. Do not close any asset account, do not close any liability account, and do not close any equity account. Sometimes students get confused by the unearned revenue account. Do you remember from chapter 3 what kind of an account unearned revenue is? It's a liability. And because it's a liability, do not close unearned revenue. A lot of times students think because it has the name revenue in it that it's a revenue account, so they try to close it, messes everything up. It's a liability. Do not close that account. And then the last thing, we're going to use income summary as a temporary account to close out the revenues and the expense accounts. Okay, with that, now let's go to the 4 steps of the accounting process. First step, close the revenue accounts to income summary. And when we say close, we mean do whatever it takes to set the account to zero. Well, you need to know the normal balances. Revenues always will have a credit balance. So what does it take to close something with a credit balance? Well, you've got to debit it by whatever amount the account balance is. So that's what you do for closing the revenue account. Close all revenues. You might have service revenue, you might have interest revenue, whatever revenues you have, whether it be 1 or whether it be 10, close them all. So you will debit each revenue by their respective balance, and then you are closing them to income summary, so you do just the opposite to income summary. You will credit income summary. Second step is to close expense accounts to income summary. Same thing. This is kind of a no-brainer. You know the normal balance of expense accounts will always be debit. So what do you need to do to each one of the expense accounts to close them, to give them a zero balance? You need to credit them by their respective amount. So again, you could have 5 expenses, you could have 50 expenses. However many you have, you're going to credit each one for the respective balance and then debit income summary. Step 3. Okay, now we've closed revenue, we've closed expenses to the income summary account. Now the third step is to close income summary to capital. Do whatever it takes to close income summary to capital. What I would recommend is using at least one T account for income summary. So what I would do is I'd make a T account of income summary, and when I close my revenues, I go ahead and post that to the income summary, and when I close expenses, I go ahead and post that to the income summary account. Then on the third step here, all I have to do is figure out, okay, what's my balance in income summary, and you do just the opposite to close it out, to give it a zero balance. Do whatever it takes to give it a zero balance, and do the opposite to capital. Notice I did not say close capital. Capital is an equity account. We do not ever close capital. We're closing income summary to capital. All right, fourth step. Fourth step is to close withdrawals to capital. Withdrawals will always have a debit balance. So we're going to credit withdrawals and debit capital. All right, now let's do an example. Back to the Kidd Company. It says on December 31st, 2010, the end of the accounting period, Kidd Company had the following account balances. Assume they are all normal balances. Again, you need to know the normal balances. All right, step 1. Again, step 1 is close all revenues to the income summary account. Well, looking here at the Kidd accounts, how many revenues do we have? How many different revenue accounts do we have? I hope you're thinking 1. We only have 1 in this case. It is just service revenue. There's that unearned revenue account. I'm going to put that out there for bait because I know students grab on it. That's a liability. Do not close that again. All we close is the service revenue. Service revenue balance is $12,000. It's a normal balance. We know that revenue accounts have a normal balance of a credit. So what do we need to do to close service revenue? We need to debit it. So the journal entry is going to be to debit service revenue for $12,000 and credit income summary. Second step, again, is to close all expenses to the income summary account. Well, we look at our expenses. How many do we have here? It looks like 1, 2, 3, 4, 5 is what I count. They all have a normal balance. We know the normal balance of an expense is a debit. So what do we need to do to close the expense accounts? We need to credit them. So that's the journal entry we're going to make next. We're going to debit the income summary account, and we're going to credit each one of those respective expense accounts. As you can see, we did. Oh, I said 5 expense accounts. I was wrong. How many expense accounts do we have? We actually have 4, don't we? So I only closed out the 4 expenses. Step 3 is now to close the income summary account. And as you recall, we had credited income summary for $12,000 when we closed revenue. And we debited income summary for $10,300 or something like that. Take the difference, and we're going to close income summary for that amount, $1,700. So our income summary had a credit balance of $1,700. To close that out, we debit income summary for $1,700, and we credit capital for $1,700. Do you know another significance of that $1,700 number? Do you know what it is? It's net income is what it is. Okay, step 4, close withdrawals to capital. We see we've got one withdrawal account for $400. Withdrawals has a normal balance of a debit, so we need to credit withdrawals for $400, just like that. And we debit capital for $400. And that is the whole closing journal entry process. That's all there is to it. A couple other things I just want to take a minute and mention about Chapter 4. The author spends quite a bit of time on worksheets in Chapter 4. You need to know what a worksheet is. I want you to know what a worksheet is, but I'm not going to hold you liable for actually working a worksheet. If you've looked at the homework problems, you'll notice that I did not assign a worksheet problem. That's because, again, I'm not going to hold you responsible for doing worksheets, including on the exam. On the next exam, there won't be any actual problems on worksheets. A couple other things about the chapter. I want to make sure that you look at the accounting process. We're done. We've gone all the way through the accounting process now. And so I want you to pay particular attention. And it's clearly illustrated in the chapter there. But make sure you understand the accounting process that we go through. So from now on, in the rest of the course, we're not going to add anything to the process. We're just going to add in between and fill in some holes on the accounting process.